There we are. It looks like we're waiting on about 10 more people to show up, but we'll just get started. Great panel. I'm looking forward to this. I'm going to sit here and pay attention to the whole thing, but in the background. So, Ed, it's off to you.
Good morning. Thank you for logging in today and watching this panel. I'm excited. We have a great group here. We're going to talk to you about capital markets and talk a little bit about multifamily as well. I'm really, really impressed with the panel that has been selected. We have, from Dalton Scatch, which is the CEO of Golden Gate, and Dalton has been focused mostly on blockchain management as well as blockchain acquisitions. We'll talk a bit more about that as a new capital structure. We have Jonathan Payne. Jonathan is the senior director from Walker Dunlap. Jonathan has had many years of experience, which you call the true professional, both on structuring debt and equity. So we look forward to seeing what Jonathan is going to be talking about today. And then we also have Ari Rostiger. Ari is the CEO of Rostiger Property Company. Amazing guy. He's been, just flying very fast past few years and has a lot to talk about. He's doing some amazing developments. So let's just jump right into it, guys. I mean, this is a very, very interesting time that we're in right now. As we were hearing on the previous panel, the COVID has kind of made a life change for us in the industry and probably in our personal lives as well. But as Winston Churchill said, never let a good crisis go to waste. Well, I see this as a significant opportunity. When you see what we're seeing right now in the marketplace, and when capital markets get kind of frozen, and when things change the way they are so abruptly, that's always going to put cracks into the foundation, and those cracks allow entrepreneurs like ourselves to get in there and make some change, and also emerge into a whole different type of business. So I'm looking at what we have in store for today. So let's talk a little bit about this. In terms of multifamily, I'm wondering what we're seeing in this industry with in COVID. Right now, we're seeing a lot of activity from collections, and just want to know from you guys, since you own quite a bit of multifamily, Ari, maybe you might tell us what kind of the fundamentals have you seen so far in with regards to COVID?
Yeah, I'm happy to do it again. I'm Ari Rastegar, founder and CEO of Rastegar Property Company. We're an Austin-based private equity firm. I started the firm, after spending some time in law school in St. Mary's. I did pass the bar. Otherwise, I think my dad would have killed me. I knew I wanted to be in real estate most of my life. And to me, I couldn't agree more. I mean, I think this is arguably the greatest buying opportunity since 1986. I mean, if you look at a lot of the similarities between what happened to the capital markets in '86, obviously for different reasons, there is certainly plentiful opportunity, and multifamily will be a flight to security. And I think that's the most important thing. So if you look at a macro level of the United States, rents were collected, around 92% across the US. But if you handicap that against New York City right now, they just broke 15,000 vacant apartments, up from 4,200 vacant apartments at the same time last year. That's an unprecedented number for a city like New York City. And you're going to be watching prices begin to really come down in a meaningful way, and watch an exodus from the primary markets in California and Texas start coming, into Texas. 1 million people left California last year. 150,000 of them came to Texas. Over 1.5 million left New York. They're going down to Florida. And people have a lot of uncertainty around the other asset classes, retail, hospitality, for all the reasons that we know. So real estate investors need a place to find security, and what we're finding tremendous value is in vintage multifamily. So people are starting to leave that urban core, which I don't think is permanent, quite frankly. But for the foreseeable future, people are thinking more about safety, and vintage multifamily. And to put that in perspective, is what the old Motel 6 might look like. 2 stories, outdoor access, no gym, no elevator, things that would have been a knock 6 months ago. But now we're seeing a record, record applicants wanting to be in that area because of the inherent social distancing and the proximity that you have to the urban core. So the value add potential of that type of product is tremendous. Okay, and people are more price conscious than ever. So that if you have a Class A finish out, so to speak, have good proximity, handle all the deferred maintenance, you could charge 30 to 40% less than what you're getting at the Class A new development. And I think that's a tremendous opportunity for a variety of reasons. Certainly in the secondary markets that we focus on, Austin, Texas just became the 10th largest city in the U.S., ironically enough, surpassing San Jose, the heart of Silicon Valley, which I find to be just a little bit funny. The advent of Tesla bringing the largest gigafactory in the world to Austin, and Apple and all the other good things that we know. So I think multifamily is going to fare very well over the coming years, simply as a flight to security.
Well, Ari, you mentioned that. I noticed you're building 5,000 square feet of single-family residential and multifamily, as well as the number of units you already have under management. Is that giving you any pause for concern based on what we're seeing in the markets today and the trends we're reading about? We're talking about the COVID situation, and we know that so far we've had a lot of federal funding that's been helping with collections in multifamily, but that has run out as of September. Are you any concern about?
Not at all. Not at all. Not at all for us. Okay. And I have to handicap that with Austin is a totally different anomaly. And all of our vintage multifamily pre-existing assets are in Austin, and we own approximately 270 acres of undeveloped land in the Austin MSA. We also have a high-rise lot in the Opportunity Zone in Phoenix, Arizona. We have a high-rise lot on McKinney Avenue in Dallas, across from Clyde Warren Park, that will ultimately be a high-rise condominium project. But we actually collected over 99% of our rents during COVID. And by surveying some of the tenants, it was the exact reasons that we alluded to before, is that they didn't want to be in that urban core. They were a little bit more price conscious. So being in a vintage property, 30-year plus, vintage, after the renovation, they could save a little bit of money and have a little bit of safety. The problem with developing current multifamily now, we have 2 projects that are still kind of confidential, but one will be a seminal, iconic work right on South First, just outside of Austin. We own, just outside of downtown, we own 3 acres that we're partnering with one of the largest developers in the world. That's what I can tell you. And we're seeing the need for this type of product, but the capital markets still are very, very weary of ground up development because, they're trained to be a little bit more conservative there, but the demand is there. And so I believe that once the capital markets start to become a little bit more efficient, you'll see the product come out of the ground. We own 200 acres in Kyle, Texas, which is about 15 miles south of Austin, that will be building 700 single family homes, 200 multifamily units, and a brewery and a little bit of commercial. And what I think is a little bit interesting is, COVID has accelerated some of these issues, right? And I'd really, like to talk to Jonathan a little bit about this. He has more of the expertise around the capital markets, but the capital markets have become pretty inefficient from a development standpoint. But what I'm super bullish on is Fannie Mae and Freddie Mac on the agency side. Our most recent Fannie Mae quote was 2.6% on a 12-year term fixed. 2.6% is, that number is unfathomable. That's almost like negative interest rates in Japan, right? And so there's that one side when you're going towards the agency side with a little bit more equity, you can lock in the best rates ever imaginable. And I don't think we're going to raise rates for the next 10 years, especially for how much money's been printed. But I'd love to hear from Jonathan of, what he's seeing in the capital markets, being that Walker is, I believe, this year is still the largest Fannie Mae Freddie Mac originator in the country. So, Jonathan, what are you seeing? Do you kind of echo some of the stuff I'm seeing? What are your thoughts there?
Yeah, so I think, and thank you again for this opportunity. But Ari, you're right. Agency lending is delivering so much positive leverage in ways that people just haven't seen before. I mean, to your point, my team just closed a deal in outside of Boston at a coupon rate of like 2.4%. But what's interesting is alongside of that, it's not just the agencies anymore. For the right asset, for the right caliber sponsor, we've seen life companies start to really compete with the agencies as well. Yeah. We've got a bid right now in hand for a deal in infill Atlanta, type 1 product, and that's at treasuries plus 160 with no floor, 10 years by up. I mean, it's a lower leverage deal, but still.
But is that a larger deal size, out of curiosity? Because obviously with Freddie Mac Smart Balance, you can go down to $1 million. So
that's a high rise. Yeah, no, it's a larger, certainly.
I'm curious. Hold on one second. Jonathan, you've been doing this for quite some time. I'm hearing some great rates as you're saying regarding financing, but in terms of acquisitions, we're seeing that acquisitions are down 70%. For the fourth straight month. So I'm just wondering how many deals are actually coming through that are getting done with these low interest.
We have to be careful. We have to be careful about that statement, right? And I know that's why Jonathan's kind of laughing here, is that they're looking at the holistic real estate market when they use 70%. Now you're talking about retail, you're talking about commercial, hotel, hospitality, and a lot of these larger assets are driving those dollars. So you have to look at it more so we have to frame that. Right. So we're talking about multifamily. Multifamily is moving. I saw $1 billion portfolio trade out. I'm sure you guys saw the JLL at pre-COVID pricing. Okay. So multifamily is moving. And by the way, cap rates are not expanding. And especially in Austin, in Nashville, and Raleigh, and the areas that are growing, the opportunity is that you can actually buy the asset. And that's what we've been telling our team. It's like, you're not looking, the blood in the water that people thought they were going to see in value add multi just didn't happen.
Yeah,
let's just call it.
You're actively buying and closing multifamily deals, institutional grade deals right now, and you're paying, the market cap rates for them with a smile.
I'm paying them because I'm getting them, and I'm having conversations. I'm an Austin native. I'm born, I literally grew up on the I-35 corridor, grew up in Dallas, high school, born in Austin, law school I studied in San Antonio, and assets that I thought would never be for sale. I mean, owners that, we all know, very well, that always said, I'll never sell, families that have had these for 10, 20 years. But the fact that we can get them, that's the opportunity, if that makes sense. Yeah, right.
Absolutely.
So this massive cap rate expansion, it's just not going to happen. By the time the vaccine comes, I'm cautiously optimistic that in the next 12 to 18 months, we'll have a vaccine. The market just has not responded the way it has. Obviously, you're seeing massive distress in the special servicing side for those other asset classes, but we can't frame that 70% drop if we're talking about multifamily. Jonathan, Dalton, correct me if I'm wrong.
I think you very succinctly identified the dichotomy in the marketplace, right? And I would take that a little bit further, right? So multifamily, pricing, maybe transactions went on pause, they stopped, call it late March, early
for
April.
6 weeks.
Right. And you had a handful of trades when institutions were on the shelf, and you would have private buyers, private capital, 1031 money that would come in and maybe, look for a haircut. Maybe they got 6-7%. Walker sold a deal in Central Florida that was, it was an Orlando deal, it was a value add deal. At the end of the day, the discount was wider than that. The flip side of it was the buyer still had a huge premium. The seller still had a huge premium in terms of what their overall profitability was. And so it created liquidity for them, which was great. Where you might see opportunities today are in multi-product type owners that have distress throughout the portfolio. And they
because they're crossed with other assets.
Yeah. Well, not even crossed, but just, the source of liquidity is the multifamily. And so if I feel like I can get absolute premium pricing again for my multifamily asset, I'm going to go ahead and sell that to create liquidity and provide support elsewhere in my portfolio. That's really the only kind of distress that you see, and it's not generating a distressed price. And it goes back to sort of what I was saying earlier about what the financing markets have done, right? I mean, you can look at debt, and you talk to my colleagues in Southern California, and their first response is, we finally have positive leverage, because they were buying deals in Southern California as sub 4 cap, right? And so leverage wasn't accretive. And now when you get sub 3% debt, it's accretive. And so all of a sudden it works. But you go take that a step further and go, well, cap rates on multifamily are incredibly aggressive, pre-COVID levels. What does that mean? Well, it means that values are high, but at the same time, the yield premium for investing in multifamily relative to investing in a 10-year treasury is as wide as it's ever been because the treasury is so low.
That's such a great point. Dalton, I was going to ask you about this. So are you seeing more transactions? Because obviously you understand that blockchain world that I don't understand very well, but has this boded well for you during this time of where, some of the capital has been a little bit slow to transact, certainly some of the smart money. Our investors are public pension funds, family offices, insurance companies, and we bought 5 different, properties, incidentally, 3 of them from Walker, Forrest Bassett, Walker Dunlap is a dear friend of mine, and we bought a ton of stuff from him in Austin. But I'd be interested to hear from Dalton on, have you seen some of that blockchain capital, kind of bolster the market a little bit during this time when some of the other traditional equity markets have been a little bit frothy?
Well, I have to say that I've been chasing deals starting in May. Actually, I started my new business in May, and over the past month, I've been out raising money not only for my business, but to go up and buy up deals in the future. And, I'm starting to think that we're going to be going out and acquiring in quarter 1 or quarter 2 of this next year rather than right now. The investors that I've been speaking with kind of want to see what happens after we stop giving stimulus checks, after the eviction notices, people are allowed to be evicted, and then also after see what happens in the election, and kind of just see what what 2020 brings us. But one of the benefits of using blockchain technology is that for all of those retail and hospitality investors that would have done anything to get out their money in March or April of this year, right? They would have sold at 60 cents on the dollar. This is probably 59 cents more than they're going to get in January of next year. Blockchain really offers that opportunity to these investors.
That's what I was hoping you were going to say. That's very, very, very interesting. And effectively, they're looking just to not, have special servicing foreclosure stuff, right? So if there's another way to access capital like that, I think what you're doing is obviously it's it's the nascent stages of what that business is. But as it begins to mature and the regulations begin to mature, I think you're onto something, really, really special. So I look forward to kind of watching, how your career iterates in that regard. Something I don't know much about, so I'm really looking forward to learning.
Absolutely.
I mean, Dalton, you've done several deals. I mean, hundreds of millions of dollars worth of off-market deals last year. Are you seeing the same kind of transactional volume that you have seen before? I mean, has anything changed in terms of your focus on deals going forward?
Well, it was different because Goldgate previously, for the past 3 years, what I was doing is I was sourcing off-market deals for large REITs and private equity groups all around the country for industrial and multifamily properties. So I was working with guys like Ari, going out, finding them off-market deals and bringing those deals to them and getting paid my fee. And so at the end of last year, I said I didn't want to do brokerage anymore. So I went and spent some time doing some traveling. And then I was in Brazil in May of this year, came back because my vacation.
How did you come back? You're in Brazil. What made you come back? I don't think people come back with young men like yourself go to Brazil. You're not supposed to come back.
Yeah. You know what? Everybody that spoke English,
right?
Yeah, everybody that spoke English left Brazil, and I saw an opportunity. I said, you know what, vacation is over. I said, not only do I think that the United States is going to come out of this better than any country in the world, but I think that Texas is going to do the best as well. And so I said, okay, well, I have my location, and that's the most important thing in real estate. Let's go create something.
That's great.
Hey, Jonathan,
that's great.
Yeah.
let's talk about, the financing today. I mean, what are you seeing? What are the great deals that you can present? We're all focused really on multifamily right now. And so you've seen deals close. Maybe you can tell us what kind of LTVs we can expect on acquisitions going forward. What kind of
lower LTV and holding interest reserves. Tell them to stop it.
Go ahead.
Well, I think that's it's an interesting question, and apologize, my signal kind of faded a bit. But I think your question, Ed, if I can repeat it, is sort of what are we seeing, and what are the impediments in the capital markets, and what can we do better? And that's based on the context of Ari asking me to go to Fannie and Freddie and tell them they should just waive every governor that they've put on their lending.
Come on.
Look, we would all love that in some respects.
No, it was a good move. It was a good move. Look, it was a little bit painful, but there's also groups out there like Fortis that'll go in there and actually give you a pref equity piece to release some of those interest reserves.
There are a number of solutions, whether it's tearing down the senior loan and taking pref equity on top of it so you don't have a reserve. The question is sort of how much leverage do you need, and what do you need, and where do you need it?
More.
Right.
More.
Yeah, everybody wants more. Not always. Some people want, interest rates locked for a long time at very low rates.
No, I'm just playing it.
I know. I mean, look, I will tell you, Walker's seen a tremendous increase in HUD financing for that very reason. Particularly the 223F program, where you can, originate proceeds up to 80%.
85 in some ways.
85 in some cases. 80 is a little bit easier, particularly for people that have projects that
have
are
1 year to close.
Right. On the equity capital side, I think it's pretty interesting. Ari, you mentioned that there is a limitation on development, and I would say, like all things, generally yes, but and I think we've seen in the last 60 days a number of capital providers are moving more aggressively into the marketplace. I've got bids on a deal in suburban Atlanta from, an opportunistic vehicle, a large multi-strategy asset manager. We see if a project has a reason for existing in a market like Houston, which is very oversupplied, there's still capital for that too. But I think
we don't say the H word in my office.
Well, listen, I'm from here, born here, raised here. So let me extol a few of its virtues. The scale is immense. After Dallas, it's the only other market that's added 1 million people in the last 5 years. And so you really need to not just sort of look at Houston and go, I can't do this. At the same time, on a relative basis, I understand why you would spend your time in Austin. I mean, there's so much pressure on value. There's so much demand that is driving pricing there. Now, Houston's an interesting market because, it's very volatile. We all know that it's very volatile. When supply and demand get out of whack, when oil prices go sideways, it creates disruption. So if you're investing in Houston with a 3 to 5 year time horizon, you're going to really be a market timer. And that's all you're going to be. You're not in a market that's got a supply constraint, a regulatory structure that's going to have your rents just tick up at 3% per annum with your eyes closed and your hands.
No, but the good thing about Houston is those submarkets, the Cadies, the Woodlands are on fire.
They're all their own unique space. And I think the other thing to think about Houston is, if you look at rent growth over a 10-year period, if you look at rolling 10-year CAGRs for rent growth in Houston over the last 30 years,
killed it.
You're averaging anywhere from, on the low end, the worst period is flat. The best period is, 3%, 4%, and the average falls out somewhere right around 2% rent growth. So if you have an extended time horizon, you're able to develop here and deliver value. And so if you're doing an opportunity zone deal in Houston, there's a reason for that to exist. If you're doing a public facility corp structure in Houston right now, there's a reason for that to exist, because you're going to have an advantage where your price point is relative to your overall sort of yield metrics because of the tax dynamic. If you're building a product that is uniquely positioned in the marketplace, I don't mean you've got a better pool or you've got a cooler gym. If you're doing something that is offering the same quality unit that you could get in a high rise, but you're doing it in a mid-rise format with no amenities, but your rent is now $200 a month less than your competitor that's, you know, the name brand merchant built product, that probably has a reason to exist here too, because you've got a value proposition to a resident that's different than what everyone else is offering. Now, that being said, it's still a difficult place to get deals done outside of those kind of dynamics. And when you look across the country, to your point, Ari, markets like Nashville, Austin, Atlanta, Raleigh, Phoenix, all have dynamics that are saying, you know, invest here. And a lot of that is based around what the realities are about the shifting macroeconomy in the country, right? I mean, Amazon's adding a bunch of jobs in Nashville. Alliance Bernstein pulled a bunch of people out of New York and they're relocating them to Nashville. Go look at Midtown Atlanta, what's going on around Georgia Tech. Go look at what's happening in Phoenix with Silicon Valley Flight. I mean, Denver's been the biggest beneficiary of this, and it's, you know, way out in front of everybody else. I don't even feel like including it anymore.
Well, they overbuilt multi, and I think that's why it kind of fell off the radar. They overbuilt the urban core on the multi side, but it's absorbing now. It was a little bit delayed, but it's absorbing.
The point is like, people are following those jobs, and so you have to find a way as an investor, and so you have to find a way to think about that and respond to it. And
that's great.
And those markets are attracting capital even today for development.
So Jonathan, help us understand, you know, people are dialed in to kind of hear what kind of deals they can get right now, what to expect. Because, you know, even though we're saying things are very rosy for multifamily and the trends look great, you know, some people may differ with that, and they're thinking that this is a good time to start looking for, you know, better yield, better cap rates. Whether they materialize or not, we don't know. We'll have to see. But what kind of financing can we expect today in terms of loan to value on an acquisition for either a Class A deal that's stabilized, or, and I'm talking about Houston, and you can talk about other major markets as well, or even a Class B value add? What can they expect from you in terms of the debt side? And then we'll talk about the equity, but let's know what you think on the debt.
You know, I think the short answer is, at this point, every individual asset is different. And so I hate to sort of punt.
Totally.
But, you know, you could look at 70%, 130 cover as sort of a rule of thumb, right? As a good starting point for Houston today from the agencies. And then it's a question of, well, what's the leverage? You know, are you going down? Can you push rate down because you delevered the deal? You know, what's the nature of the sponsorship? What's the nature of the occupancy? You know, rent collections in Houston have held up fairly well,
Absolutely.
by and large. You know, we can talk about why that is. You know, depends on how political you really want to get.
We don't want to go there.
I really don't. I mean, but you know, you can go look at the major REITs, and you know, Camden will tell you that Houston's one of its best performing markets for collections, and there's a reason for that. You know, that being said, lenders have all of the same headlines that every investor has. It's the reason why Ari called Houston the H word, and they're cognizant of that. So
I didn't hear the H word, but I won't. Don't repeat it, Ari.
You know, so you know, that being said, multifamily with cash flow, there's a market.
You can finance it.
There's a market for that, and there's a market for that. That, you know, if the agencies aren't there, there are other lenders that are there for that. I mean, people don't want to. This is the other, you know, four-letter word that people don't want to use. But you know, CMBS loves multifamily. They can't get it. They can't compete with the agencies, right? But go into a market like Houston where you've got, you know, a headline risk issue. If you can prove up your performance in your asset, they'll be there for you.
So you're still factoring in rent growth for value add deals?
Oh yeah.
Well, that's a different question, Ed.
I know, but I just want to hear your viewpoint on that because, you know, for the past couple 9-12 months, people have been buying value add multifamily deals, and, you know, the cap rates have been compressing on that kind of product. And you look and say, wow, somebody's paying a 4.5 cap for value add multifamily deal, maybe kind of core plus location. And they're factoring in rent growth after the value add. Are you buying on that? Are you financing that right now?
You know, there's a bid for that too. It's a different bid, and it depends on what the business plan really is, right? Is this we're going to go in and do an aesthetic remodel on an asset where we're paying a 4.5 cap, but 70% of the units have already been done, so we're only doing the last 30. You know, that's a harder sell, right? And most of that value add has been picked over, if you will.
Totally.
You know, I think when you do that, you're really thinking about it more in terms of not the pure value add economics from a return profile, but you know, there are a number of groups that are out there that, you know, their view is what they call a restore to core, and it's not necessarily, you know, can I get a mid to high teen yield for a value add program, but can I go modernize a product that's 10 years old that just needs doesn't need 5 to 10,000 a door, but you can do it for less than 5,000 a door, and maybe you're not pushing as much lift into the rents there, but you're able to keep your retention higher. You're able to move your rents a little bit, and then the response is that you've got, you know, kind of a high single digit, low double digit all-in yield, and then you've got the leverage that supports that as well.
Yeah.
So on average, in terms of cost of capital, where would you say a person who is like Ari is looking for acquisitions of an existing stabilized product, where would you say the average cost of capital would be?
That's a tough question to answer too.
You know, for which investor?
Yeah.
Right?
Well, let's say for Ari, and then we could talk about, you know, for Dalton who's looking for a Class A product.
So Jonathan, so to frame that for you, because I know that look on your face of why that's a perplexing question. So let me frame that a little bit, Ed, because that's
Ari, why don't you just share with us what you're looking for?
Yeah, exactly. Well, I'll give you two things. So, you know, we actually during COVID, as a lot of you know, we closed a bunch of deals during COVID, and Walker actually sourced for us. I had a deal that, you know, in the Mueller area, phenomenal location, unbelievable. And the seller was being a little bit obtuse for my taste. And I totally get it. A lot of people were scared during that time. And actually Walker was representing us on the acquisition, Forrest Bass and his team, which were absolutely remarkable. They left the HFF to start the Walker Dunlap Austin Investment Sales Group, and they were just spectacular, absolutely incredible. We bought tons of stuff from them too. And we also went to Walker on the financing side. So we were able to close on a deal because the bridge markets had basically frozen, and bridge markets really exist because of the Fannie kind of takeout. Even though Fannie was doing $14 billion a week, the bridge lenders got a little bit weary in that kind of March, April, you know, kind of time. So Walker procured for us a 9-month term with Revere at around 8% at 65% LTV. So for multifamily value add that you're looking at 35 to 40% lifts post $20,000 a door renovations, that's egregious financing. I mean, that's just absolutely horrific. But the risk is that you don't close and you lose your EM and you lose the upside opportunity. So now we're refining it into a bridge at, you know, 280 basis points above LIBOR, you know, 2 years with a 1-year extension, you know, typical stuff, which no problem. We were able to close on it. Okay. But with that said, a month later, we were able to go through Greystone and get 300 basis points above LIBOR, you know, on a 2-year term on a bridge that, you know, had, you know, one coverage that allows us to complete our value add and, you know, do a gut renovation, right? So it really is a case by case basis. And there was about a 6 to 8 week hold in the capital markets that were unbelievably, ridiculously painful. But that has changed dramatically. So that's one discussion if you're going down the bridge route of what we're seeing on stuff that I like. And I'm a value add guy. I don't buy core. I buy older stuff in fantastic locations near new developments where we can buy at a discount to intrinsic cost. I buy by the pound mostly. I'm not cap rate centric. I go in there and go do the work, increase the rents, buy from mom and pops off market, find expense efficiencies, bring institutional controls, and increase rents. You're actually, developing NOI from two directions, right? And if you move that into a takeout and move that into Fannie Mae, there has never been a better time in history to go to a takeout. So, so you really have to frame what that really, really looks like. So as far as I'm concerned, the capital markets have freed up pretty dramatically if you have a real value add. And for me, I don't touch something if it's been renovated. Like, look, in the renovation with guys putting in $2,500 and putting new knobs on the, on the cabinets and repainting it, that's not value add to me. We take it down to the studs, we do all the deferred maintenance, and we turn it into an annuity. So for us, the type of capital for that, where your business plan can show between 18 to 25+% rents on an initial kind of lift in year one, or year one, 18 months, whatever you want to call it, I think the capital is pretty accretive. I don't know, Jonathan, if you'll agree or not, but we're seeing good stuff, certainly in the strong markets like the Austins and the Raleighs and the tertiary markets of Houston.
Yeah, I mean, I think you really identified what I was getting a little squeamish, Ari. And it goes back to what I said, the value add that's a true value add,
there.
You can make that case, but you're going to sit there and someone's going to sit there and go, well, where are your rents today? Where are you taking your rents? Where's the market? How are you getting there? What are you doing? What are the schools? What's the neighborhood? Like, you can't go buy, stuff that hasn't been touched, and it hasn't been touched because no one wants to live there, right? And if you're buying, crime and you can't control that, or you haven't shown evidence to control it, I mean, there are certain things that you're going to have to be able to discuss. And then, in defense of my colleagues on that bridge loan you got, I will say your timing couldn't have been worse. Because
it could not have been worse, but I give them so much credit for closing the deal. No, they got it. So don't misconstrue.
No, I'm not.
It was actually a fantastic solution in a horrible time, and to do it. So under the circumstances, it was great. In any other circumstances, so it was actually fantastic, and it was Walker. And what I liked about it was Walker found the deal. They worked with the seller, and they procured the financing, which is one of the great benefits of a firm that you all have. I have a tremendous amount of respect for your
we don't need to make this a commercial. I do appreciate the compliments.
I have no vested interest in it. I just know from what y'all have brought me with Forrest and what the guys have done for us. Is second to none. Newmark and for us in Austin have been tremendous, and Walker, which is obviously Forrest's new shop, has done amazing work. So you deserve those kudos.
Thank you for the compliments. But I think to the market dynamic you're referring to, you're right. I mean, the Fed had yet to step in. The lending markets, and not just the bridge market. The bridge markets went upside down because so many of the bridge lenders that were had underlying financing from CLO, so whether a mortgage REIT, whether that CLO market shut down.
That's right.
CMBS market shut down because no one could issue in price. You saw corporate bonds in late March and early April run way up. The Fed hadn't stepped in with any kind of credit support, so you were seeing a repeat of 2008, a form of that, right? In terms of we live in an economy that's a really levered economy. And when you have dislocations that cause lending to stop or lending to require pricing to really gap out, it's really painful, right? I mean, it's just what was going on. And so it caused a lot of people to stop. I mean, the life companies all said, if you want to do a 50% loan, we can issue you a loan at, 4.5%, 5%, because I can go get a AAA rated bond, A- rated bond,
and sell it like this.
Yeah, I've got total liquidity in it, and that that's the way the capital markets work. So when whether you're talking about a $5 million bridge loan or a $50 million, low 50% LTV stabilized loan, I mean, the consumers of that paper are all investors, and they're looking for yield relative to the risk and liquidity, the profile of that paper. And that was a moment when everybody said, we're going to put our hands in our pocket and see what happens. And if we can get really paid to do something special, great. That was there. I was talking to MetLife, and they were winning Amazon distribution center build-to-suits at like a 6.5 cap. Okay, that's a product that today, the bid is probably a 5 on the forward, and if you sold it with Amazon in place, is in the 4s.
So, Jonathan, we're going back to the question on pricing. We talked about value add, and Ari was very eloquent in telling us the different types of value add he's doing. But in terms of Class A stabilized financing, trying to let the audience get an idea of what they can expect on various loan values. So what do you think you can do on a Class A stabilized asset on average? I mean, we're not trying to,
Yeah, I think Class A stabilized, you're again, market dependent, but you're, on the low lever tier 4 loans, you're looking mid 2s. And as you add leverage, we've got a deal we're taking out. It's a small deal in Arkansas, but it's a stabilized deal. And that's going to be sort of high 2s to 3% on, call it a 75-ish% levered loan.
Wow.
We're going high as 75%. That's awesome.
Yeah, but in Arkansas, in fairness, the cap rates are significantly expanded, so they have much higher coverage on that type of product.
Huge coverage. There's huge coverage.
There's huge coverage, and so you can't compare that to what you would see in the Texas, Houston, San Antonio, or even Nashville. Any of those other cities that we mentioned that had that growth, you're not going to see cap rates expanded like that. So that's a unicorn for that market.
You're gonna run into like a 130 cover.
Yeah.
So Jonathan, if you that's great at the 75.
And I will say the other
That's
piece
gold.
is
it's great.
What happened in collections in the last month, right? So you want to talk about the trophy assets?
Yeah.
You're going to have a conversation about where were collections in the last month. So that deal I mentioned earlier with the life company in Atlanta, the reason that the life company is being more successful there is they understand the product and they can underwrite with a view to where the market's going. So even if that deal in this moment is a little soft because they've had, some collections trending away from them, not towards them, they're okay at a low leverage and with the sponsorship knowing where that goes. And so they can step in and provide that substitute for the agency, where the agency goes in and they look at it and they've got a limitation as to how hard they can look at where your rents are going and how much credit they can give you for being who you are and where the pricing is and the leverage is. So that's just one of those.
Let's say that what can you do if the LTV was even more conservative? I mean, I'm glad to see that you're able to go very high on the capital stack, but what if you had a sponsor who was actually looking for a 55% LTV?
Yeah, you're low.
How many basis points lower can you, on average, can you
2.2%, 2.4%.
Yeah, I mean, it depends on the affordability component. Some of the deducts, right? But yeah, if you're below 2.5.
I want to show you guys something. I think that
Generally speaking,
Dalton can also kind of jump in on this, because this is where we see the markets and where we see capital markets right now. With blockchain, I believe there's a new capital markets product coming out that you guys may not be familiar with, but I want to kind of give you a preview for it so you can see what Todd just put on the screen. The cryptocurrency owners out there are $300 billion strong right now. And, they've been holding crypto and growing year over year. But one thing in their benefit, they want to hold on that crypto because it seems to keep going up and up and up. So they want to lend on it. And when they lend on it, they want to lend to assets that are going to actually help them balance out their portfolio. But currently the crypto owners don't get any kind of yield. So they have a lot of volatility, but no yield. So we've partnered with some of the largest crypto banks in the country. in the world, actually, who are focused on how they can diversify. I'm not sure if we can move this over to the next slide. There you go. So these crypto banks are sitting on right now about $300 billion worth of currency, and they charge their users by the pound. So how much you have in your account, they'll charge you a custodial fee, and that varies on the custodial fee. But you can see how difficult it might be when you see. First of all, you're charging a fee on a checking account that people can just continue spending on, so that balance keeps going up and down. But also, you wish you had a more stable currency that you can charge fees on, because of course the balance goes down, you can charge less fees. So moving that into hard assets like commercial real estate that actually provide a yield is a major incentive for this category of capital. Next slide. And so, what we've done, I didn't really introduce myself, so I assumed all you guys knew who I was, but I founded a company called Red Swan, which is a commercial real estate marketplace where we actually digitize high quality commercial real estate. We're starting off with, the best Class A Type 1 assets, mid-rise construction, but eventually we'll be doing, even B value add product as well. But the beautiful part here is that they can now invest in these products, and they'll be part of the capital stack. So you won't have only the traditional large institutions coming into this capital stack for new developments or for acquisitions. You now can have a new asset class, kind of like your crowdfunding exists today, which is actually tearing up, doing extremely well in the marketplace in terms of competing with some of the major equity sources. But this class now is just looking for pure yield and upside and stability, as opposed to what they're having by sitting on cryptocurrency. So this is just give you an idea of how people can come on board and indicate how much they want to invest in a class like this. And you can see on that last slide that it was basically a low cost per entry. So a person can buy shares into this right here is a $280 million high rise in the CBD of Oakland, California. And you can see their initial entry cost is $42,000. That's unheard of, but that's also very appealing to this asset class. Next slide, Todd. But you can also see that the reason why I was asking these questions, Jonathan, is because from the capital stack, you can see that this new form, you can see the traditional on the left-hand side, which is basically your banks taking down up to 60% of the capital, and then you have your LPs, and then you have your GPs. But now you can see on this new cap chart, where this new Reg D and Reg S, which are digitized shareholders coming in, and you can actually have a blend of both. But you can see how this will change the capital stack structure, making it easier for banks or traditional lenders to be able to easily put in their 55% and give the best rates, because they're lower on the capital stack than before, which is still preferred. You can also see that we anticipate that there's going to be a liquidity premium, meaning that people will pay a higher price to participate on a good piece of real estate, because they're not getting any yield right now. So they're able to get 4.5% or 5% yield at a preferred level, where they're getting 0 right now. They're probably going to pay for that extra price point because of liquidity, meaning they can get in and get out anytime they want, like a stock, and also because it's an asset class they haven't been able to buy into before. Next slide. So, this is real estate, as you know, globally is a $54 trillion marketplace. We're seeing quite a few properties now signing up to become digitized, at least digitize part of their capital stack, either for acquisitions or for new construction, or like I said, recapitalization. There's at least 30%, and Ari, you can probably tell me how much equity you think you have in your assets, but at least 35% of pure equity locked in real estate that can't come out because it can't be financed out unless you have significant gains in the value of the asset. Banks always want to keep their position on the LTV or LTC pretty constant. But now owners are able to sell down that LP capital stack and generate capital and still maintain ownership in terms of GP ownership of the project going forward. So that means you can pretty much finance up to 95% sell down of your equity, maintain 5% as a GP, continue to charge your fees and manage the asset, and then also have the waterfall as you improve the asset over time. So next slide. So anyway, the beautiful part about this is that once you engage in this type of capitalization, you're actually taking, and it's available, we have it available right now, partnered with our institutional crypto bank. You can actually transfer cryptocurrency directly into digital securities without having to convert it into dollars, USD. So now it makes it very easy for them to invest into this capital stack and then also receive their dividends in the cryptocurrency through our technology. So just wanted to let you guys
Great job.
kind of understand what's going on, and this is happening right now. Let's show the next slide. I'll just kind of give you another preview. So we're actually, we have about $3 billion worth of assets right now we've already tokenized. You can see the quality of these assets, Brooklyn, New York, Houston, Texas, also California, Oakland, California, all type 1 construction assets. And we're raising about $600 million worth of equity in the market right now. So I wanted to bring that to your attention. I wanted to know that, make sure that Jonathan, you're aware of it, so that if there's sponsors out there who want to recapitalize and they have this type of capital equity, they can come to you to get debt, which I'm sure you'd be pretty happy to facilitate. So
Ed, I think for the audience, that's fascinating, and admittedly, I know very little about a coin-based economy. So I noticed on your project list, it looks like those were developments. So how do you, with the digital capitalization, how do you translate from the crypto environment to the USD environment? Where does that take place? Because if you're building something, right, you're building a $100 million project and you need $40 million of equity capital, that 40 million, whatever percentage of that would become coin, has to translate into dollars to pay subcontractors and land sellers and everyone else and general contractors. So walk the audience through that.
Sure. Good question. Well, first of all, the technology exists today, like Coinbase, for example, it's our crypto bank, and they sit on $60 billion worth of cryptocurrency right now. And we're able to, since we have a Coinbase account, commercial Coinbase account, we're able to have the current crypto holders, just transfer their Bitcoin or their Ethereum or Litecoins into USDC, which is a US dollar stable coin, which doesn't fluctuate. It moves with the dollar. So if they move that into our account, then we actually have dollars in our account. We can now move the shares into their account. And
so that's effectively
that's how it's done.
Or that's effectively the currency conversion. So it's no different than if somebody.
Exactly. Yeah, they never have to convert to US. They never have to convert to US dollars. As US dollars, the dividends are received and dividends are put into the account. We now convert that dollars into, like I said, USDC, and then transfer it to the wallet of the cryptocurrency holder, and they're happy with that dividend in their cryptocurrency form.
And Jonathan, there are also
you're the
do this too. So there are a few ways that you can do this. You don't have to use crypto in order to do this. For instance, people can invest with US dollars, or like at least on my platform, you can invest with US dollars, euros, or Bitcoin. So let's say that I'm raising money, they would send it to an escrow account, and that escrow account, we work with banks that are able to convert that to our preferred currency, and then we're able to use that for investment purposes. And then after the money's been raised and we acquire the property, then we issue their proportionate shares in the asset. And what's beautiful about this is that we're raising money not only from people all over our country, but also all over the world. And what's amazing is that in the United States, we have a certain investment threshold that we have to meet. But in other countries, such as maybe Argentina or in Italy or these other countries, I mean, getting a 2 or a 3% return in the United States is a lot better than losing a 50% return on their real estate in their own
currency
country.
hedge.
So,
it's also a currency hedge.
Yeah,
exactly. And so, maybe you might have somebody in America that buys into a multifamily property in Austin, or maybe in Austin or Dallas, let's call it at a 5 cap. And they buy in at a 5 cap, and 1 year goes by, and they go, you know what? I want to get a new car. I want to buy a house. Or maybe I don't like Dalton anymore, or I don't like the deal, or the geography, or for whatever reason. And they go, you know what? I want to sell it at a 4 cap, or whatever, or whatever price I want to sell it at. Now, it doesn't mean that you're going to get it, but since Ed and I are bringing international investors to our platform, there's a higher likelihood that that person might be able to have gotten at a 5 cap and sold at a 4 cap. So it's the opportunities for it are endless. And rather than maybe if you're trying to get out of a deal in March or April, and there's only 6 other people in the deal, it's really, really hard. There's legal costs. You lose a lot of your principal. It's a lot of time, and you probably won't invest in real estate again. But now if you're able to reach tens of thousands of people with the click of a button, that's very powerful stuff for not only for our investors, but for us as well, because we're able to go out because of course we want to make our clients happy. But if we have some clients that are just a little bit too much, I'm sure that Ari and all of us have had those kind of clients. Rather than say, oh my gosh, I'm with this client for the next 5 to 7 years, this is terrible. Now we get to say, hey, it's kind of like, hey, if you don't like Apple, then sell your Apple stock, right? If you don't like what Apple's doing, sell your Apple stock. If you don't like whatever company is doing, you have the ability to sell your equity and get out. So it's providing people, especially this younger generation, where we can't stay with anything for longer than a few, maybe minutes. Right, we're the swipe right kind of generation, and we need it now. We need Amazon Prime now. We really can't make those long-term commitments. So offering those investors where they go, okay, I feel comfortable because now I have equity shares in multifamily in Austin, industrial in Phoenix, and maybe a hotel in Atlanta, Georgia. And at any point in time, I have the ability to sell all of my shares and move to Brazil. That's powerful.
It is powerful.
So the point being, all the volatility of the crypto, that risk sits either with you guys or with the investor, because once the translation occurs, the real estate operator, the GP, has live dollar, it's digitized, but it's dollar denominated.
It's like you sold your stock. It's like you sold your stock.
And the volatility, like you said, is with cryptocurrency right now.
Yeah,
but cryptocurrency, when they want to, minimize volatility, they go with stable coins, right? And the USDC is a stable cryptocurrency coin that moves with the dollar. So there's no volatility. So you think about it, from the standpoint of recapitalization, which is really what I want you guys to focus on. You take a $100 million asset that currently has a $60 million debt on it for whatever interest rate, and basically you can now refinance this asset. We can bring that $60 million down in terms of debt down to $50 million, and you can provide a more attractive financing. They can now, an owner like Ari can sell down 95% of that equity at $100 million at current rates, pull that cash in his pocket, still hold 5% going forward as a GP, but now he has all the liquidity in his pocket to go buy more and build more, which makes a lot more sense. I don't believe it's necessary for people to have to sell their asset in order to monetize their liquidity. It makes more sense to keep building and adding to your portfolio and collecting dividends and collecting management fees than it does to just hold on to equity. Because look at a lot of people right now in other food groups who have a lot of property. They're property rich and cash poor, and they have to sell off because they don't have liquidity. So this is a solution to that problem.
And those investors require a 4%, 3% debt-like yield.
I'm not sure I'm not sure. I didn't hear that question pretty well. Sorry.
From a yield perspective, for your investment,
what are they looking for? Is that what you're asking for?
What kind of yield do you have to?
Yeah, it varies on the asset, and I'll start talking
on that slide. It said
it varies. It goes from 4% to 8% in terms of preferred return yield. So it's still pretty attractive compared to your mezz or your preferred equity you're seeing on the street. Equity is the tough part. Debt is pretty easy because there's a lot of competition, but equity is pretty expensive if you don't have it.
Yeah.
Well, we got to balance, gentlemen. This is a fantastic conversation. I have a weekly show on Mondays, Ed, called Power 30. It's a 30-minute Q&A deal. If you would come back on and talk more crypto, I would love to have you, because I think this conversation's got legs that are going to continue for quite a while.
Absolutely. We'll
I
do
put up in the chat room there, I put a link to back to the lobby. So go back to the lobby, get ready for panel 3, and I'll be back with those folks live in a couple of minutes. Thank you, gentlemen. Great
Nice meeting you all, gentlemen.
Thank you.
Appreciate it. It's recorded. It'll be on YouTube later this afternoon. So
Thank
if you
you.
want to go back and rewatch it and figure out what they're talking about, you can. Thanks, everybody.
Great,
Thank you, guys. Thank you, guys. Take care.